In this chapter, what I want to go through is another trading system which relies more, again, like the previous one, on us having missed the initial move and so not having got in there. But in this one, we're looking to get on the pullback as the market falls. So this is for short traders, i.e. those looking to make money from falling prices, whether through future CFD, spread bets, whatever, and or options for that matter, or covered warrants for that matter. And it's also for those who are short-term, obviously, as well. Short-term trades. So, what does it require? And I'll show you an example in a minute, but I'll give you the rules first. Sharp uptrend, so we want to see quite a steep rise upwards, not one which has lasted 6 months or something, but one which has lasted maybe a week, couple of weeks. It's fairly steep in that regard. The entry is, after a sharp rise, the price fails to make a new high, a new daily high. In other words, what's typically exemplified by such a sharp rise is that each day it makes a new high. It just keeps on going up and up like this. But the warning comes when it has a day like this where it fails to make a new high relative to the preceding day. Then the next day it makes a new low relative to the preceding day. That's our warning sign. We're looking for a retracement of 25% from the base of the rally to the peak of the rally. So if that is the base of the rally to the peak, we're looking for it to drop roughly 25% of that distance, of the whole distance. Again, I'll show you this in a second. With a 50% retracement also being fairly likely. The exit point is when the price, as it's been falling, makes maybe, and it depends, a 2-day high. So it might be falling like this and it makes a 2-day high. That's where we exit. Or it might be a 1-day high, depending on how risk averse you are. The warning sign before an exit comes when it fails to make a new daily low. In other words, it's been retracing, falling down, but there comes a day when it doesn't do that. And that's a warning sign, and we might get out near the close of the day, maybe at 4 o'clock on a day such as that, before the market actually closes, when it's quite clear it's not going to make a new daily high, a new daily low. But the actual exit comes at a 2-day high. Let me just show you this in a proper format on an actual picture. So there we go. We've got this rally which we missed. That's why we're able to see it. We completely missed this. And you can see how each day it's made a new high. And then we had a day here where it fails to make a new high and actually makes a new low. And the next day we're looking to get in around here, either at this low. Doesn't happen. The next day it just continues going upwards. But we've still got this entry barrier, and we get an entry point around there when the price actually falls on this day below that. And we're looking for a retracement of 25% of the distance from here to here as an initial target, and maybe a 50% drop. And a 50% drop will be somewhere around here. You're looking for this to happen. Yep, that's on a pullback. The other thing about pullbacks is you want to look for patterns. And typical patterns that happen in pullbacks are these near the peak on Japanese candlesticks, where you get a high, you get an upward move, you then get a very small move. If you don't know about Japanese candlesticks, don't worry. This is more for those who do look into that area, and then you get the fall. That doji, that evening star, is a good example of a bearish turn. In any event, you can see again the rally. We've got a rally. We missed all of this, remember. Fails to make a new high here. And actually, we've got for that either there or here a new entry. We've got a 25% retracement, and then it moved off. Typical in this example where it didn't go through, it went back up again. We probably lost a bit of money or didn't make much. In other words, the opportunities can be quite slim because sometimes it just doesn't go through to the 25% retracement mark, and it's already down 25% from its low to its high. Remember, that's that's that. 25%, that's this mark here. It's already down there by the time you get an entry signal. So what's happened is, if it doesn't go further and it starts moving this way onto a 2-day high, like around here, and let's say you entered at any point below that, which you would have done, you already very quickly lose money. But that I wanted to show you as one which doesn't work, what it can look like when it doesn't. Because a lot of people, what they think with trading systems is they work 100% of the time. They should always enter them. If it doesn't feel right, doesn't look right, then we don't want to. One way to add greater success to pullback trades is if this rally is even bigger, because that gives you more room from where you enter to the 25% retracement mark and the 50% retracement mark. Incidentally, sometimes they even hit 75%, but that's relatively rare. So we are looking for a 50% retracement if we can get it. We are looking for exits that I've mentioned. We're looking for the first warning sign being a failure to make a new high, and then the next day breaks beneath that, or the next 2 days breaks beneath that, and that's the trigger with a fairly tight stop loss, so that our losses are fairly limited. And that's a pullback system.